Hello everyone, my name is Muhammad Fadhil, and today I will be presenting my research on the topic How does corporate social responsibility affect financial performance in the banking sector in Indonesia? Here is a quick overview of what is to come. Okay, getting straight into it then. Corporate social responsibility, or CSR, is defined as the integration of social and environmental concerns into business operations. It reflects a company's commitment to acting ethically and contributing to economic development while improving the quality of life for society. Some common CSR initiatives include carbon reduction, fair labor policies, and charitable activities. These actions not only benefit society and the environment, but they can also contribute to a company's long-term success. The strategic role of CSR goes beyond just doing good. Well-executed CSR initiatives can enhance a company's reputation, foster customer loyalty, and ultimately lead to improved financial performance. In the context of Indonesia, state-owned enterprises are mandated by law to allocate 4% of their net profits towards CSR programs, which must focus on areas like partnerships with small and medium enterprises and environmental management programs. This regulatory framework makes it even more critical for banks and other companies to strategically manage their CSR initiatives to maximize both social impact and their own financial performance. The primary research question for this study was, what is the impact of corporate social responsibility on the financial performance of banks in Indonesia? And the research objective was to investigate the effects of corporate social responsibility on the financial performance of banks in Indonesia. The main aim was to determine whether CSR activities drive profitability or whether they mainly improve non-financial aspects like reputation or stakeholder trust. In reviewing the literature on CSR and financial performance, I found that CSR is rooted in the idea that companies are responsible not just to their shareholders, but also to a wider group of stakeholders, such as their customers, employees, and the community. Several studies have shown that transparent CSR practices can enhance a bank's reputation, which in turn improves value perception among customers and investors. Moreover, investments in CSR, particularly in areas such as education, healthcare, and sustainability, have shown to increase operational efficiencies and profitability. For example, studies have indicated that banks with strong CSR initiatives are more likely to have loyal customers and attract better terms for financing. To explore the relationship between CSR and financial performance, I conducted a quantitative analysis. The reasoning for using this approach is that I wanted to quantify the data and identify any statistical relationships between CSR spending and financial performance indicators. The research strategy involved desk research, analyzing financial records, and sustainability reports from Indonesian banks. This provided valuable data on both the financial performance and CSR activities of the banks. The key independent variable was CSR expenditure, and I controlled factors such as total assets and whether banks was a state-owned enterprise. For data collection, I gathered financial data for five major Indonesian banks from the Orbis database. The data covered a 10-year time span, allowing for a more comprehensive analysis. I use sustainability reports made public to extract information on each bank's CSR expenditure. The main financial metrics used for the analysis were return on assets, or ROA, a measure of profitability relative to total assets, return on equity, or ROE, a measure of profitability relative to shareholders' equity, and net interest margin, a key indicator of a bank's profitability, reflecting the difference between net interest income and interest expense. In terms of regression analysis, the general formula used was y equals beta plus beta 1 times factor 1 plus beta 2 times beta times factor 2 plus beta 3 times factor 3 plus error, where y represents the financial performance variables ROE, and net interest margin, where the x1 represents CSR expenditure, x2 represents total assets, and x3 is a dummy variable for state-owned enterprises. And now we'll see the findings. The key findings from the regression analysis is as follows. For ROA, as you can see, the p-value is 0.293, which shows that it is not significant and therefore suggests that CSR spending does not have an immediate or direct effect on profitability of banks in terms of their asset usage. Similarly, for ROE, the p-value is also above 0.05, which shows no significant effect. This aligns with prior studies where CSR impact on equity profitability might be indirect or long-term. However, for net interest margin, the p-value is 0 and the coefficient is positive, which suggests that CSR investments may influence non-financial aspects such as improved customer loyalty and better relationships, which can enhance the bank's profitability through improved net interest income. In the discussion, we see that CSR expenditure has a positive effect on net interest margin, but it does not significantly impact traditional profitability measures like ROA or ROE. This supports the idea that CSR initiatives may have a more indirect impact on financial performance, particularly through non-financial channels such as customer loyalty, reputation, and social capital. These findings also highlight challenges faced by state-owned banks. These banks tend to show operational inefficiencies, which may explain their lower profitability. This inefficiency could be related to the government's broader policy goals, which may divert attention from profit maximization in favor of social objectives. In contrast, private banks seem to be more efficient in translating CSR activities into financial performance, particularly when these activities align with their core business strategies. To conclude, the study found that CSR spending does not significantly impact ROA or ROE, but it does positively influence net interest margin, suggesting that CSR initiatives can boost profitability through enhanced customer relationships and reputation rather than direct financial return in the short term. Additionally, state-owned banks face significant challenges that limit their financial performance. These inefficiencies hinder their ability to maximize the benefits of CSR expenditure. Based on these findings, here are some recommendations. For Indonesian banks, prioritizing CSR initiatives that are aligned with core business strategies such as improving environmental sustainability or supporting local communities. This alignment will help maximize the long-term benefits of CSR. It's also essential to ensure transparency in CSR reporting. Detailed and transparent reporting will build stakeholder trust and potentially enhance the reputation and credibility of banks. for state-owned banks, they should address their operational inefficiencies and adopt more targeted CSR strategies to improve their financial outcomes and make better use of their CSR investments. For future research, I suggest using a more advanced regression model like panel data regression to better account for time-based variations. Expanding the dataset to include a broader range of banks or different countries would also improve the generalizability of the findings. Thank you for your attention. I hope you enjoyed.